dollar for dollar asset protection basis, and there are many other states now that are considering that. And it only makes good sense that they would do it, because if they're giving us incentive to self-insure the first 3 years of our care, the odds of them paying anything out is just that much less. What about the person, though, who comes in and says, gosh, you know, if I pay $4,000 a year for a long-term care policy, I'm just throwing that number out, and I pay that out over 20 years, that's a lot of money. Yes, it is. But in 20 years, is $80,000 going to, what will it buy? It might give you 3 months care in 20 years. It's kind of like thinking of your current health insurance, your car insurance, your homeowner's insurance. You know, the odds of you having a car accident or your house burning down is far greater than having a health care need. It's probably more like a 1 in 3 ratio, which is pretty scary. But you still look at that cash outlay, and some people are just really not comfortable paying out that premium, thinking, well, you know, if you're like me, I'm not going to go to the nursing home, I'm not going to need care, why would I pay that premium every year? I still believe that traditional long-term care insurance that I just explained is the Cadillac. It's the very best way for you to protect assets, but there are other ways to do it with insurance. One of those is an annuity with a long-term care rider. I'll keep it simple by just saying, for example, $100,000 that you have in a CD in the bank gets placed in the annuity. There's a long-term care rider with it. If you need care at some point in your life, the $100,000 is used first, and then if you need care beyond that, the rider kicks in and carries for as long as the rider that you purchased, 3 years usually. So it's kind of like the partnership plan in a way, because you're saying, okay, I'll pay the first $100,000, and then the insurance company has to pick up the balance. The premium on that rider with the annuity is typically a third of what it would be with a traditional long-term care policy. So people aren't quite so hesitant to pay that, knowing that they're in their mind that they're probably going to be able to pass that $100,000 on to their named beneficiaries. Another way is with life insurance. We have a lot of policies now that have, for some time, have had an escalator clause in them, whereby if you became critically ill, the policy would pay out a portion of the death benefit early. So again, $100,000 life insurance. If you became terminally ill, you could get up to, say, $75,000 of that to use during your lifetime, and then the remaining $25,000 would be paid out at your death. And there's a little more complicated language that goes along with that. But if life insurance is a good answer, then that's sometimes a good option for some people that don't want to pay the traditional long-term care. So those are 3 ways that you can fund long-term care. And of course, the first way most people are doing it is they're paying out of pocket, they are having families help, and wondering where it's going to end. With some portion of protection in place with a policy, at least you know you've limited it to some degree. And that's why people are continuing to investigate. The best way to find out how this all plays out for you is all a very personal decision, is to meet with an advisor, go through the numbers, but it really comes back to this, you know, what is your greatest need, what is your greatest concern? If it doesn't come from here and you just say, oh, well, I just want to protect assets for my kids, sometimes that reason doesn't hold water. It might in the first few years, but then later on you might question, these kids can take care of themselves. So we have a long talk. When I have clients come in to talk to me, we talk from the heart and find out what your real concerns are, what your values are, and what it is you're really trying to accomplish in order to solve the problem of that concern. And probably the hardest thing right now is with the healthcare issues that are going on in the United States. Many people are wondering, you know, should I just back off and wait a while and see what shakes out? And I would just caution you to keep your eyes and ears open, read all the fine print, because nothing's nailed down yet and we don't know what it would be. But I do know that part of the bill says that there will be some offering of long-term care, and we've already matched up the numbers, and private insurance will give you about double what the government plan would. And that's just, throw that out there right now as of this date, August 11th, 2009. And I say that because we are being recorded, and by the time this is actually aired, there may be a lot of changes to that. But just, I say that just because you need to be aware that nothing is in stone yet, and that you probably are putting yourself at some risk to depend totally on the government to take care of you. I appreciate you coming this evening, and if you have questions, please stay and I'll be glad to help you with the answers.